Thank you very much. I want to follow up, Michael, on the point that you were just making on scale-up capital. So it sounds like you think we've got a bit of a problem in this country with companies that get launched, get capital initially, they get to a certain size and then they go off elsewhere. So what would you recommend the government can do about this, not just in terms of ensuring that we have the funding for scale-up, but that those companies who receive it stay in this country once they do receive it?
There are multiple dimensions to this, inevitably, Mr. Davis, and I appreciate funding is but one of them. If we look at the other way around, this is a hugely exciting opportunity. I mean, different people put different labels on it, whether it's the scientific superpower that we want to create or a fantastically successful set of regional economies in England and the devolved nations over and above that. But our industry, as you've been hearing described, starts from that earliest stage after you've run out of money from your family all the way through to some of the biggest names in venture capital basing themselves in the UK to invest in the opportunities here. At each stage, you have a different set of individuals with different sets of expertise around the type of capital and the amount of capital they're investing and the sectors into which they specialise. It's been one of the corollaries of the growth in the industry over the last 40 years, particularly the last 10, is that you get increasing specialisation in these different areas. And without being trite about it, if a lot of the hard work has been done by UK-based fund managers and the entrepreneurs they are backing, but they then don't have the capital pool on which to draw to move on to the next stage. You get up to increasingly bigger and bigger $100 million funding rounds and so on. That very quickly wipes out the entire allocation from a lot of the different fund managers that exist in the UK. You inevitably go to those with the deeper pockets, and increasingly that means you'll be looking at the United States. Now, we're very open to that capital, we love it and everything else, but what we're not so keen on, or we think there's potentially a lost moment here, is that with the decision making and the influence that goes with that, then people, teams, developments can move elsewhere. So undoubtedly we want to see more capital made available. Now that's where we get into, and Will referenced this earlier on, actually where are there big pools of capital in the UK? Defined contribution pension schemes are one such potential source. Changing the rules around Solvency too, but the risk profile of how the capital is allocated by insurers and so on is another potential source. Candidly, I think we also need to build up the investment expertise that will deploy those sums of money, because we've been working very carefully over a long period of time with Treasury and others to look to see how we get access to the capital. It's not a guarantee that should we get there, we hope we will, that then the capital will be deployed. So on multiple levels we are keen to see that. And we know that BEIS, the Treasury and others are pretty actively looking at areas of the economy or areas of British expertise that they would like to see grow, and talking to people along the river in the city to see that they've also got the expertise to make the investments.
I guess what I'm getting at, and I hear what you're saying completely, and it's particularly interesting on the expertise point, but I guess what I'm getting at is, to what extent is the issue structural, putting aside the volume point you make about the United States, which we can only do so much about, how much is structural versus cultural in this country?
Well, if I may pray and aid the report that was done by the Scale Up Institute, Innovation Finance and Deloitte for a year or so ago. I mean, they essentially identified a growth capital gap, a scale-up gap of £15 billion per annum. They identified that, broadly speaking, half of that was structural, and probably half of it cyclical. And in terms of the structural side of things, what they were talking about there were about the approach that we've adopted as a country. It's inevitable over time, Parliament legislates, governments decide on tax arrangements and regulated environments, and they're not all necessarily designed to help holistically to deliver the best investment environment possible.
Yep.
But there are complications that we might sort out there, and getting access to the capital is part of that. There's also as a point that I think has been raised already, around the UK, outside London, sometimes there's a lack of capacity to actually look at the investments and ensure that there are funding pools there to match it. I mean, the phrase they use...
Michael, is there an appetite? So in that report, you just mentioned the Scale Up Institute report. In that report, it also says that 63% of all investment into UK tech businesses came from overseas. That's up hugely. It was 50% since 2016. So, and in the written evidence from the PLSA, they weren't exactly glowing about reforms to unlock pension capital for venture capital investments. So is there an appetite, is there a risk appetite issue, cultural issue that we have in this country compared to the United States that maybe we just can't do much about?
If I may, I'm slightly wary of making us v America and say us v France and Germany. Otherwise, where is there a pecking order of risk appetite? It's very much an individual thing. Culturally, too, you might argue. I think the difference is the United States is just many leagues ahead of us in terms of the depth of the capital available and the sophistication of the ecosystem that goes with it. I said at the start, our ecosystem is hugely impressive and important relative to the rest of Europe, and because we sit here in London, we've got access to a global hub of expertise in finance. That's brilliant, but we're on a journey that's not quite got us to where the United States is on its. Is there an appetite? Yeah. I mean, we see lots of great businesses, and you see the investment is growing year by year. What we'd hate to be doing is reflecting at a future hearing of the committee in 3, 5 or 10 years' time saying, oh, what a shame, we missed out on those opportunities.
Okay, so let's say we unlock, we've got Solvency II coming down the track, we're going to come on to pension funds shortly, but in more detail. But say we unlock a lot more capital, is there a risk that that money actually goes overseas? How confident are you that our businesses will get that investment if we unlock UK pension assets, for example, or UK insurance assets? How confident are you, retail assets, how confident are you that money will actually stay in our country?
Well, I think we're an open economy, so let's concede that the investment flows go internationally both ways. I mean, we're celebrating the fact that actually some of the shortcomings at the moment are actually being put right by United States or Asian or other sources of finance, and that's to the good of the UK economy. I think that openness is a real strength. Could some of it? Well, it depends on the rules that are put around the schemes and what the trustees of those schemes think. But let's put it this way. Ontario teachers, techs and retired teachers, and plenty of other public sector workers in California and elsewhere get lovely returns, outperforming returns for investing in UK venture capital opportunities, which seems slightly strange that we miss out on here in the UK. So they get those returns as things stand. We'd like to get more access to that to balance that up.
Well, how do we compare in terms of investment performance of our companies that you're investing in, for example, your members are investing in, compared internationally?
So difficult to directly compare at our stage because they're all early stage. But I think the point, Mr. Davis, if I may make, is the fact that venture capital in its entirety has grown and has developed so effectively over recent years is because there are some really exciting companies coming through. So do we need to worry about whether the opportunities will be there for the pension funds to benefit from? No, we don't. There's an enormous number of really exciting businesses. It's seen by the growth of valuations, particularly in areas like fintech in particular. These opportunities are coming through. The concern, I guess, for all of us is to make sure that there's a sufficiently developed UK availability of capital, that those businesses are funded and stay in the UK.
And what's the typical time horizon of an investment in a VCT?
In terms of how long we're invested in our online companies, it's usually around 7 to 10 years. It's probably longer than one might imagine.
Okay.
What we are seeing now, is as those businesses get to the stage of handover from what we do to non-incentivised, we are increasingly seeing US funds investing in those opportunities because they see relatively a better opportunity than they perhaps do in the rather more competitive and more developed market in the US. So we really want to make sure that we aren't losing those opportunities.
Okay, thank you very much. I want to switch just briefly to seed capital. Christiana, can you explain to us your perspective on how we are as a market for seed capital?
Yes, absolutely. Thank you very much for the question. I think the UK does pretty well for seed capital. We are one of the best places in the world to start a company, and that is a huge achievement that should not be taken lightly. I think when we look at seed investment, though, education is really key here, and there's still a lot more that could be done when it comes to education. I know that the UK BAA surveyed 200 women in their network considering angel investment, and 90% of women were unaware of EIS tax break and hadn't been advised on it by an advisor. So that just shows that where it's working well and where the schemes are known, it is very, very effective. But there are parts of the country, in particular outside of the southeast, where the education around SEIS in particular, but EIS as well, is not as successful, and that is where there's a real opportunity, and it's a huge priority for ESA, but also there's a real opportunity, I think, for MPs and other people involved in the ecosystem to really champion these schemes and make sure that the entrepreneurs in your constituencies are aware of the opportunities available to them, and equally that the investors are playing an active role in this area as well.
So the Federation of Small Businesses have said exactly the same generally about tax reliefs, overall, but you're saying it also applies to SEIS. You've suggested that we, maybe as MPs, need to spread the word, but what else can be done? What can the government do? What can other parties do to make sure that this is made aware of, businesses are made aware of?
So a huge part of it is about connecting people and the infrastructure. I think where we've seen, as has already been mentioned, the infrastructure existing and working really well and very familiar with EIS and SEIS as well as others, then entrepreneurs are aware of them and find out. Often entrepreneurs find out about SEIS initially and EIS from other entrepreneurs. So where they're not as connected in the same way as they are in certain parts of the country, they may not be finding out about these schemes until it's too late, as I've already mentioned. So working with the various interest bodies, whether that's entrepreneur networks, but also accountants, lawyers, the investors as well, organisations like ESA and others here today, and the UK BAA as well, I think is really important. But a lot more can be done in this area, although there have been some good efforts already.
I think in your written submission, you've recommended that the limit for SEIS go up to 250,000. Can you just explain that a bit more, and how you think that will have a material impact on seed capital?
And thank you for picking up on that as well. So as it currently stands, the limit for investment into a company, the amount of money a company can raise using the Seed Enterprise Investment Scheme is £150,000. Now, this was set in 2012 when the SEIS was first created, and it hasn't been adjusted for inflation. So considering the needs of entrepreneurs now, companies have quite different needs. Their initial round is likely to be a slightly larger raise. And what happens at the moment is one of two things. Either they are doing their initial round under SEIS but having to come back to the market fairly quickly to raise additional capital in order to grow, which is taking up valuable time for the entrepreneurs involved that could be spent focusing on the company. Or the other thing that often happens, and again this was noted by the UK task force that I mentioned earlier, is that they do two separate rounds. So as it stands, SEIS and EIS must be issued on separate days. So what sometimes happens is that entrepreneurs do an SEIS round and then the following day an EIS round. And this is just additional administrative burden on the entrepreneurs, which doesn't seem to make a huge amount of sense. So our recommendation is to increase the limit on SEIS to £250,000. This would bring it in line with inflation, but would also represent the additional needs of the companies involved, and would try and reduce some of that administrative burden that I've mentioned. I feel it's important to put this in the context of the sunset clause, though, as well. And if there isn't the EIS and VCT schemes available at a later stage to help them increase their growth and further have an impact, then it has to work as an ecosystem as a whole.
Okay, thank you.
Great, thanks very